Welcome to the deep dive video update. This is a video that I do once a week where I go through all the charts that I used specifically in the daily videos, and I pick out those charts that maybe I'm not using right now, but I still want to look at them. I still want to do a video about those charts because sometimes we can still get some insight from looking at those charts. And there are also some charts that are unique just to this video that we use more for informational purposes, just to get an idea of what is happening in the market overall. This is being prepared for Monday, June 9th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. This is a chart that I only use in this particular video, and it's a chart of the VIX, but then there's a 50-period exponential moving average over top of the VIX. Then I turn the VIX invisible, and this gives us an idea of what is the longer-term range of the VIX. And we're still below this red line of 20. Now, we have been going up so far in 2025 because stocks have been under pressure. And then we really went down in March and into April. And now we're finally starting to roll over here as the VIX has dropped back under 20 itself on the daily side. And it never did get above 20 here with the longer term range. So that's still keeping us in this longer term positive range, at least for now. Then we look at the speed of the VIX as measured by a short-term RSI. That's a momentum oscillator. And I only show this chart in the daily videos when we're above 70 or below 30. We're below the midpoint as the VIX has been coming down and, as I said, dropping under 20. So the momentum for the VIX currently is down. Now, I don't have it in this video, but if you watch the daily videos, I also show the MACD, another momentum oscillator, which tries to give us the overall momentum of the VIX itself. And after really coming down, as the VIX is coming down, we're starting to cross over positive there, but the VIX really hasn't moved all that much, and now the MACD is pretty much going sideways. All right, then we look at another study which looks at a correlation between the VIX and the S&P. We're getting very low readings right now. We get concerned if we go above the dashed line. We're not there, so I haven't been showing this chart. Then we look at the VIX and we take a ratio of the VVIX, or the volatility of the VIX, or the VIX of the VIX. And as a general rule, when this is going up, that's more negative. When this is coming down, that's more positive. And we have been declining lately. And we look at the Skew Index, which is a variation of the VIX, where the VIX uses at-the-money options to be calculated. Well, the Skew Index uses out-of-the-money options to be calculated. And when we pay attention to this chart is when we're up in the red area. Well, we're not there now. We're just about at the midpoint, so we're not really getting any additional insight from this chart. The Ulcer Index, I only show it in the daily videos when we go above the moving average. Now, on the weekly side, we're still above the moving average, but coming down. We're here on the daily chart, we're below the moving average and now going sideways. We look at a ratio of the volatility of stocks and the volatility of bonds. And generally, when this is coming down, I follow mainly the red line, which is a 50-period exponential moving average. This shows the volatility is coming down for both stocks and bonds as stocks have been going back up. Then we look at a ratio between large caps and small caps. Not really gyrating around all that much. Not really showing any upward move or downward move right now, so there's been no need to show this chart. And then this is for information. We hit the low back in October 2022 after being in a cyclical bear market, and then we're up 71.7% as of Friday's close. Then we hit another low in October 2023, and we're up 46.22% as of Friday's close. And then we were really screaming to the downside, and we're up 24.1% from the April 7th low. And that's a really big bounce that we're seeing, that we have seen thus far. Now we're above the 200-day simple moving average. We're still in a downtrend. You can see here I have a 50-period moving average and a 200-period moving average up here on the S&P itself. When the blue line crosses below the red line, that means we're in a downtrend. But it doesn't necessarily mean we're going to keep going down. This crossed right as we were starting to come back up in April. and we're above both of the moving averages now. And so we're above the red line, and this measures on a percentage basis how far above are we from the 200-day simple moving average. And right now we're 3.52% above it. Then anchored moving averages, we're above all of them right now. We'll pay attention more to this chart if we start to come down and see if one of these anchored moving averages ends up providing some kind of support. And for the most part, though, it's positive because these longer term moving averages are still going up. And the shorter term ones are more flat. But if we keep going up, then they'll start to turn up as well. Then we look at advanced decline lines. And I do a lot of different advanced decline line studies, but we haven't really been going anywhere with them lately. We haven't been falling apart, but we haven't been breaking out either. And so this is a cumulative advanced decline line for the S&P based on price, just kind of chopping along sideways. Also based on volume, it's also going pretty much sideways. So I really haven't been showing this chart. This is the NYSE, just looking at common stock, the stocks inside the New York Stock Exchange, chopping sideways, going up a little bit in Friday's session, actually looking a little more positive when we look at this based on volume. And that could be positive because when volume tends to lead price, that is more positive. Then we look at some ratios here, discretionary to staples. Now this is the regular discretionary sector to the regular staples sector, which means that it's weighted. So in the discretionary sector, stocks like Tesla and Amazon carry more weight. Well, this ratio has been coming back up and now chopping sideways. Now, to get something that's a little bit more fair, we look at an equal weight version of the discretionary sector and an equal weight version of the staple sector. This is actually showing a little bit more of an improvement here, but it had been falling back. But discretionary, it got hit hard on Thursday when Tesla was down over 14%. It did get over 3.5% of that back on Friday, but it would be more positive if we continue to see this ratio going up. Now, I do show this as a chart all by itself in the daily videos, but I wanted to include it with these other charts that also simulate growth to value here with tech, which is growth, utilities, which is considered to be value. This is starting to show some improvement, and we're getting back more on the offensive now, but we really haven't broken out above this previous high with this ratio. We are looking better with biotech, which is growth, compared to healthcare, which is value. This is showing some improvement here. And then we look at hotels to utilities. This isn't breaking out yet. What would be more positive is to see all of these breaking out at about the same time, and we're getting more of a mixed picture right now. This is a look at what we call the bellwethers, the main industries that really drive the U.S. economy. Well, semiconductors kind of going sideways after bouncing back up. Home builders, they declined. They're kind of chopping along here sideways. Transportation, going sideways. We are seeing a bit of a breakout here with retail, so that's been looking better. And then the regional banks also continuing to pretty much go sideways. These are the smaller banks. Large cap growth, this is positive, but I haven't been showing it because we're above all of the moving averages. I usually show this chart when we break above the moving averages or we start to come back down to the moving averages. And this is value. And then we look at growth only represented by tech here. And when this ratio is going down, that's actually more positive. But we're kind of down to where we've been before. We need to see this sustained decline keep going here to be more positive. When we were really going down in March and into April, this ratio was really going up. Now it's been declining, so that is more positive. We look at momentum stocks, which tend to hold up better when the market's under pressure. And we were really under pressure in March. We set a higher low here. And then we were coming up with these momentum stocks, which are showing good, solid momentum based on technical indicators. But now that the S&P has been going up, the momentum stocks have started to come back down, which means that other stocks are now starting to show better momentum. All right, then stockcharts.com puts out technical alerts every day. If they're red, they're negative. If they're blue or green, they are positive. And we started off down here. I have May in here. It should actually start one up. We start at the beginning on Monday, and then this at the top is the last signal that was generated for Friday, where we had some negative things happening, and then the latter part of Monday and Tuesday, we were looking more positive, some more negative here on Wednesday, and then on Thursday when we actually had a little more significant down day. But then things started to improve on Friday when we gapped higher and we were able to hold on to those gains and actually close back up at the 6,000 level. Then I look at 6 indexes and I score them from 0 to 100, and then I rank them here. And coming in first place are the QQQs, which is growth, and they're doing okay. It would be better if they got up into the 80s, even the 90s. That means that they were really strong. But you can see how the historical values here have been going up, and that's showing an improvement. And when the QQQs go up, which are growth, then the market tends to go up. And then the stocks that are in the NASDAQ 100 are also in the S&P 500, where the S&P 500 is growth and value together. So if the QQQs are going up, that also helps the S&P to go up. In second place is the NASDAQ composite itself, improving, coming in at 73.1. Then we have in third place the SPY, or the S&P 500, at 62.9. Then the Dow, which right now it's above its 200-day moving average, but it's really been having a hard time staying above it. It's been acting as resistance. We'll see if it's able to stay above that level in the upcoming week, but it's coming in next at 30.1. Then we have the mid caps at 14.8, just kind of flatlining, not really doing much. But what really improved this week were the small caps. These were down in single digits. And we are coming up a little bit with the technical score. Still terrible. I mean, it's 13.2. We want this thing to be up in the high 80s, low 90s. And still, it has a ways to go. But we've seen some improvements along the way here, only to have it then fall back. So that's kind of been the story the last few years with the small caps. All right, then some short-term charts. This is a short-term rainbow because it has a short-term moving average starting at 10 periods up to 50-period moving averages. And then we're going up. And this is just showing that the short-term trend is improving, and we're above all the lines, and all the rainbow lines are going up as well. Then I haven't been showing this because we've been just kind of chopping around here. I do show a chart that shows all the different moving averages together. So because I've been showing that chart, I haven't been showing this, which is just the 20-period simple and exponential versions of the 20-period moving average. And these are improving. Even when we came down, the short-term moving average here did find some support, and we were able to bounce up off of that. Then we look at an advanced decline ratio, and this is based more around the short term. It's based on 19 days. There's another one that's 39 days, but this is a breakout chart of the short-term advanced decline ratio where we're above zero based on price, and I show that in the daily videos, but this also gives us volume, and we're also above zero here, so we're showing some improvement that way. Then we have another intermediate term rainbow going from 50 periods up to 100 periods. We're breaking back above all the lines in the rainbow, and now slowly but surely the lines are starting to turn back up. Here's a 50-period moving average, which I use to measure the intermediate term trend, and we haven't come close to these. And both the blue line, which is the exponential moving average, it moves faster, and then the red line, which is a simple moving average, they're both going up here, and that's showing the intermediate term is holding up quite well right now. Then a little bit longer term. This is long-term intermediate, short-term long trend. I know, that's weird. But the 100-period moving average, we're above both of the lines. They did act as support when we were coming up and then falling back a little bit here. But we're above these, and they're slowly starting to turn back up. So this is improving things longer term. Then Bollinger Bands. Now we're seeing that the bands themselves are getting pretty thin. We haven't really been trending lately. And when that happens, the Bollinger Bands get pretty close together, and sometimes that can produce some kind of a move, either an explosive move up or an explosive move down. But right now, just looking, that's a different way to use Bollinger Bands. How I use them on this chart is, are we above the upper or lower band? No, we're not. So I haven't been showing this, but it's slightly positive because the midline is going up and price is above the midline. In a percentage basis, I just use this for information, but I plot these on here. You move this just a fraction and the whole percentage thing changes. So just shows us how we've been bouncing up, and we've almost been able to retrace all of the losses that we're seeing in March and April, but we're not quite there yet. And then the Connors RSI, which is another momentum oscillator. We look for extreme positive or negative readings. We're not getting that now. And the CMB composite, also I use like a momentum oscillator. We did come right up to the black line, but then we fell back. I only show this in the daily videos when we go above the black line or below the black line down below. Standard deviation, we've been chopping sideways, so we drop down below the moving average. This measures speed, not direction, just how fast it's going, either up or down. And it's really been trailing off a lot lately. And we look at the S&P 100 and we compare it with the S&P 500, not really seeing any divergences currently. Then this is longer term, a 10-day average of the highs and lows for the S&P. We're above 50 and going up. Now, this is actually turning longer term positive, because if we come and break above the green line, that means there's good internal momentum inside of the S&P. Now, this is a slower indicator, so it can come up here and stay above this green line for a long time, but that shows good internal strength in the S&P. So it is improving. We want to watch this and see if it goes up above here. Then I'll start showing this periodically in the daily videos. The mass index, it only generates a signal when it's up to the red dash line and the blue line, and we're far away from that now. A long-term rainbow goes from 50 periods up to 250 periods. We're starting to see the longer-term trend improve as the lines are starting to turn back up. Then this is a special K oscillator, very long-term. I just mentioned it in the daily videos. This is the video where I actually show the chart, because we get very few signals from this. Now, we're still positive on the weekly side. We came right down to the red line and we're starting to turn back up. But we're still negative here on the daily side. And it takes a long time for this thing to turn and actually go in one direction or the other. So it's still negative. Then we look at the weekly chart of the S&P US stocks on top, and then German stocks in the middle. And the correlation between the two is getting stronger. Now, Germany's been a lot stronger in 2025 than the US. You notice that they're pretty much setting all-time highs here, where we have yet to go back and set a new all-time high that was generated last February. But we are seeing an improvement with this chart. And support and resistance, this is a 20-period simple moving average of the open, high, low, close. And we've come down sometimes, and one of these lines may act as support. You can see we came down, we bounced up off of that, came down, bounced up off of that. And the lines themselves are going up. It produces this little mini rainbow here. And so this is looking positive, but we're kind of far away from the lines right now, so I haven't been showing this chart. Then we look at the Ichimoku cloud, and we're above the cloud. That's positive. And then we look at some studies that go along with the Ichimoku cloud. We see the green line, that's short term, and that's going up. That's positive. We see the blue line above the red line, that's positive. And all three of these lines, green, blue, and red, they're all going up. Now, I only show this chart really when we're kind of playing around in the cloud, but so far we've been able to hold out above that. And we look at Fibonacci retracements. This is if we really start to decline. We finally broke up above this. This was the gap where we couldn't seem to get above this level. And then the news came out about a trade deal between the US and China, and then we gapped higher. And then there's been all this day-to-day news going back and forth. It's good, it's not good, it's good, it's not good. And that's kind of sent us into this sideways range that we've been seeing lately. Well, then we did see a little bit of a breakout here on Friday, at least on an intraday basis. We closed right at 6,000 because the employment report came out and it was not as bad as had feared. And so the market ended up gapping higher and was able to hold on to those gains. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. And some broad market measures. This is the VIXen, which I mainly study the VIX, which is the volatility for the S&P 500. The VIXen measures the volatility of the NASDAQ 100. I don't watch this chart as closely. And then we look at a ratio of growth to value, the Qs to the Dow. And then we look at the S&P on top, and we see that there's a pretty high correlation here. So that means when this ratio is going up, that means that growth is outperforming value as compared to these two different ETFs. And The S&P has been going up, so this chart is looking more positive. We keep an eye on the transports and the Dow, and even though they're on different scales, the red line is still trailing behind the black line. And when we're stronger, we'll see the red line actually go above the black line here. But the transports have just, they have periods of good time and then they just kind of don't go anywhere for a while. And then the bank ETF, we're in a downtrend, but both moving averages are pretty much going sideways, but we're still below the 200-day moving average, just looking at the banks. And then we look at another ratio of the smaller banks with the financial sector. Still in a downtrend, not really doing all that great, but not really falling apart either. Then we look, I always say this is an apples to oranges comparison. This is the S&P 500, and then comparing it with the NYSE advanced decline line, which is a completely different index. And we're not really seeing much of a disconnect right now, as the NYSE actually held up better while we were going down. I mean, it went down too, but it didn't go down as much. And now that we're coming back up and the S&P is taking up a little bit more of a leadership role, it's starting to outperform, but they're not all that far apart from each other. We look at the S&P 500 weighted version and then compare it with an equal weight version. And when this ratio is going up, that means the weighted version, which often means the big stocks, because they're what really have more of an impact on the calculation of the S&P 500 itself, where the equal weight version treats all 503 stocks the same. Kind of chopping around a little bit here lately, but since we've been coming back up, we've been seeing an improvement with this chart. We want to keep an eye on retail. Now, we do a ratio of retail to SPY. Retail's still underperforming, but it's trying to improve ever since we've been bouncing back up. And then we look at retail all by itself, where it is bouncing up and it's coming back above its 200-day moving average. We're above the midpoint here with the RSI, and that's also improving as well. Then we look at another ratio of energy, which tends to be more defensive, and then the 10-year bond ratio. In 2021, this ratio was really going up. That's when energy was quite strong. Bonds were, well, they were not doing very well then. But then when we hit 2023, and ever since then, this ratio has pretty much been going sideways. A little bit above, we go up and down, but there's no real conviction right now. And so I have concerns here with a question mark. Not really at this point. We look at a gold to SPY ratio, which the SPY is the ETF for the S&P 500. We came right up to this trend line, which connects these previous highs, and now we've been coming back down with this ratio. That means that the S&P has been outperforming the gold when this ratio goes down. We look at U.S. versus international stocks. We're improving a little bit, but pretty much chopping sideways. Where going back to the beginning of 2025, U.S. stocks were really underperforming global stocks as a group. Now we're chopping sideways. Now this is not a trend line. This is just an accent that we've been going down here. And U.S. stocks have been underperforming. We'll see. They can really take another leadership role and see this ratio going back up. Then emerging markets, which are developing markets, they're not considered to be mature. And then we have developed markets, which would be like the U.S. and Europe. They also, the emerging markets, which are in an uptrend by themselves, they're still not outperforming developed markets, though. So we're seeing a bit of a contradiction here. The developed markets are doing better, with Europe right now doing about the best. Then we look at the 10-year yield in the U.S., subtract the German 10-year yield. We plot that with the dollar index in the middle, and now this correlation is starting to drop off between the two. Usually there's a pretty high correlation, and that's more normal. So we're seeing, is there some kind of a shift coming in here? Now, they did cut interest rates in the EU this past week, and there was this fear that they were going to have to cut interest rates in the U.S. Now, that probably would have sent the market higher, but they were going to have to cut rates because if the employment report came out weaker than expected, that was going to possibly make the Fed really cut rates sooner rather than later. But the context of that is negative. They're cutting rates because the economy could be slowing down and actually starting to show some weakness. Well, that didn't happen on Friday, but they still cut rates in Europe this past week, and that's causing this correlation to continue to go down. Then we look at some ratios. Staples, toilet paper, and toothpaste. When staples are underperforming here, that means the S&P is usually going up. And then we were really under a lot of pressure. We saw staples outperforming the S&P. It spiked and now it's been coming down. I haven't been showing this chart because we see like nothing and then a little bit of a spike and then nothing for a few days. But overall, this is declining and that tends to be more positive. So, but I look at this chart every day. And then we look at a 5-period moving average of the highs and lows across the broad market. The Amex, the NASDAQ, and NYSE were above zero and advancing. So that's showing some strength is coming back into the market. Here's the German DAX, just coming off. Now it was down a little bit on Friday, but it's just coming off of setting another all-time high. And we look at a ratio between U.S. stocks and German stocks, not really showing any kind of a leadership now. After when this goes down, that means U.S. stocks are really underperforming. Then U.S. stocks just blew up out of that bottom that we set in April, and now we're coming back down with this ratio. Rate of change, well, this is in the wrong spot. There should be some rate of change charts right after this. Yep, they're right here. This should have been in a different section. These are the QQQs, which is the ETF for the NASDAQ 100. I haven't been showing this because we're above all the moving averages. And I show the NASDAQ 100 chart daily in the daily videos. Now we look at the rate of change. A little bit of a pullback here, but we did drop down below zero and we've been bouncing back up. And longer term, we're also going back up after dropping below zero. And this is based on 250 periods, so it's quite long term. It takes Friday's close and then goes back 250 periods ago to calculate what's the change been between those two values. And we look at bonds, and this is still looking okay from an inflationary standpoint. We compare 1 to 3 month T-bills, which is cash pretty much, because you get like zero interest with that. And then we compare it with 3 to 7 year bonds. Now, as a general rule, when this is going up, that means the market is more concerned about inflation and interest rates. Well, we've been just kind of chopping around here, and we're actually in a downtrend still with this overall ratio, even though it did spike up in Friday's session. We use that same approach, but we look at TIPS, which are Treasury inflation protected securities. They adjust for inflation. They're usually shorter term. And this is what folks get into when they're worried about inflation and interest rates going up. And we were seeing that back in 2024. This was producing some inflation worries. Well, now we've been just kind of chopping around and this overall ratio continues to decline, suggesting that the market, anyway, people might be freaking out and the media might be freaking out about inflation, but the market isn't freaking out about inflation. And then here's a longer term look at TIPS to 7 to 10 year bonds. Not really seeing much conviction with this overall ratio. Then we look at the long-term bond and compare it with the S&P 500. The longer-term correlation is actually starting to weaken more, and even the short-term correlation based on 10 periods is starting to go down. But they're, at least in the short term, still having a fairly strong correlated relationship, meaning that they're tending to go in the same direction at the same time. But over the last few days, you can see where the S&P has been going up as the price of the long-term bond has been going down. That's why we're seeing the short-term correlation rolling over. We look at the Qs to the long-term bond, and they're having a pretty strong tendency to go in opposite directions right now, which is more normal. This is growth, the QQQs. Those are the big stocks, and they like interest rates lower. And so if interest rates are going down, then the QQQs are going up. But lately, especially in Friday's session, we saw interest rates really going up, and the NASDAQ 100 also went up. So we'll see if that relationship starts to change. And we keep an eye on the 2-year Treasury bill. This is more positive because we're setting a series of lower highs here and actually lower lows as the yield has been coming down. Then we want to keep an eye on the 2-year to the 10-year yield curve. It's not inverted and still going up. And we keep an eye on the 10-year to the 3-month yield curve. This also, it got close, but it didn't quite go inverted again. We're still above zero with this yield curve. And then this is, didn't I just talk about this? Energy to the 10-year bond, pretty much going sideways right now. And then we do another apples to oranges comparison. European stocks and American bonds. This going up just shows that European stocks are outperforming American bonds. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, This approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right. Then these possible positive scenarios, these are some studies that sometimes are helpful, but lately they haven't been. These shows the percent of S&P 500 stocks above their 200-day simple moving average. Now, when we're above 50, that's positive, and we're above 50 right now. We use this like an oscillator. When we get above 90% to the upside or 10% to the downside, that usually means an extreme reading. Well, we're not getting that right now. Then we look at those stocks in the S&P above their 50-period moving average, which also is above 50, but we're not seeing an extreme positive or negative reading. We also look at the mid caps, which continue to be above 50. And finally, getting back above 50 are the small caps after they spent quite a bit of time underneath 50. So they're improving, at least right now. And then here, what's the 10-year, what's the 2-year doing here again? Okay, I set this up a little bit different this time, and some of the charts are obviously getting duplicated here. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.